Welcome back, you legends. Today was a crazy day in the market, so let's get right into it. The S&P was up 1.3% today, the NASDAQ 2%, the Dow Jones 1.15%. Clearly, from the stock market map, leading today were the risk-on sectors: tech, communication services, and cyclicals: Tesla, Amazon, Google, Meta, Disney, Netflix, Microsoft, Apple, all led today's rally. By the way, guys, these were the biggest losers yesterday. So they gained back some of those losses today. They clawed back some of those losses. And if we take a look at the different sectors, again, leading today, communication services, cyclicals, and tech. So a risk-on rally with defensives like utilities, consumer defensive lagging the market. Let's take a look at the daily chart for the S&P 500. Very obvious from yesterday's price action was this double top formation with a negative divergence on the smaller time frames, including the 2-hour chart and the 1-hour chart. Today, the market actually gapped up to open the day on the better than expected PPI print. Month over month, PPI declined by 0.5%, and year on year, PPI came in at 3.4%, in line with expectations. And year on year, PPI came in at 2.7% below consensus and forecast, with core PPI in line with expectations. So why was that such a positive event today? Well, because PPI leads CPI, or the producer price index leads the CPI, the consumer price index. So when you start to see PPI come in below CPI consistently month after month, it indicates that yes, inflation is heading towards the right direction. Now, that's not the reason the market sold off yesterday, right? The market did not sell off because of inflation concerns, not at all. If you remember yesterday, we had a beautiful gap up in the morning. We sold off, tried to recover, sold off again on fears of recession after the Fed announced that they expect, well, they did not really announce, it was in their minutes, the Fed meeting minutes. It revealed that they are now expecting the baseline scenario for this year for a quote unquote a mild recession, whatever that means. Really, they've been calling for a mild recession. In 2008, they said the same for 2000 to 2003, and both of these really were some of the worst bear markets in recent memory. So when they say, oh, mild recession, it really doesn't mean anything. When you raise rates from 0 to 5% in a year, I mean, you don't expect a mild recession. You expect something absolutely catastrophic. But it will take time. So on the 1-hour chart, we had a gap up and then we just ran. The market just continued to rally and rally and rally. So we had a major trending day, and it's because of a very sneaky short squeeze that happened as soon as we cleared the prior highs at 412. This was a major resistance level that rejected twice on really large volume. Look at this volume, major rejection, again, major rejection. And today, the market cleared that price. Finally, we've been trapped in this range for more than a week now. And everything looked bearish yesterday, right? The market rallied initially on better than expected CPI and then sold off on recession. So rationally, you would think that it doesn't matter if PPI comes in lower than expected. The fear is recession, not inflation. But that's not what happened. We had a gap up. We now have 4 gaps below. This is very unusual. We have this gap. That's number 1. Number 2 is this gap. Number 3 is this gap. Number 4 is this gap. This is extremely unusual. 4 gaps left behind is very rare to see. And quite often after the 4th gap, all the price action that occurs after that is just algorithmic trading, short squeezes, short covering rallies, etc. And that's kind of what the VIX is saying. But before we get into the VIX, I want to show you what happened on the 5-minute chart. So if we take a look at the 5-minute chart, the market opened with the gap up. It had a lot of indecision dojis. Indecision, no idea what it wants to do. Then eventually it broke to the upside, found resistance at a very logical level. Why do I say that this is a logical level? Well, if you extend a resistance line connecting the tops, you will find yourself, boom, at this exact zone. Right, the market pulled back slightly, then held at the 10-period moving average on the 5-minute chart, then continued to rally. And as soon as we took out this prior high at 412, just look at this. A massive short squeeze took place. Consecutive buys, really no selling at all until the end of the session. Now, the market is actually very good at this. It sees where the majority of positioning is, and then it rewards the fewest number of people and punishes the rest, right? If you went short at yesterday's close, you got trapped. If you went long at yesterday's open, you got trapped. So the market is just laying one trap after the other, and this will very likely continue, especially as tomorrow we'll have Jamie Dimon. We'll have JPM reporting tomorrow, and everybody's waiting for Jamie Dimon. Will he repeat his storms are coming comment? Will he change his tune to mild recession? What is he going to say? We all know that the big banks really raked in billions of deposits as smaller banks failed and depositors fled those smaller banks and went and deposited their money in larger banks like JPM. So they raked in billions in deposits. That's something that we know for certain, and that will very likely be positive for the stock. But the question remains, how is Jamie Dimon going to guide? Is he going to guide for a worse than expected economy, a better than expected economy? What is he going to say? My guess is that he will likely avoid spooking investors, and I think the stock will rally. That's just my opinion. And if I take a look actually at JPM on the daily chart, what it tends to do on earnings is that it tends to either rally immediately, right? For example, here, gap up and rally, or open with a gap down and then rally. But if we take a look at the 3 previous earnings reports, the stock rallied at every one of them. The question is whether it's going to gap up and just open higher in the morning, or whether it's going to open flat or slightly down and then rally. Overall though, guys, we do have a bottoming doji candle today from JPM, and we have a higher low. So it is looking more bullish than bearish. But then again, we have these prior highs that the stock needs to clear. But I think if we clear those highs, the stock will rally all the way up to these prior lows at 138 over the next, let's say, couple of weeks. Now, Jamie Dimon has been all over the place recently. In one breath, he says the banking crisis is not over yet. In another breath, he says the banking crisis is near the end. So it's really confusing. Nobody knows what's going on in terms of the economy. Everybody knows it's slowing down. How bad is it going to get? When will the shoe drop, so to speak? And when will we get that nuclear bomb of a recession in corporate earnings? Now, that's the major question. So tomorrow we have Wells Fargo, JPM, Citi, BlackRock, PNC, a lot of banks, a lot of big financial institutions. And they've all been really hammered recently. So you'd expect that maybe if the earnings are not as bad as feared, those companies will rally. And the weakness in the NASDAQ tends to suggest that's going to happen. Right, the NASDAQ had a bearish crossover yesterday. After every single bearish crossover, the NASDAQ has actually already put in a top, right? In this example, it had already put in a top on a closing basis. It retraced back to the highs on an intraday basis with a major gap up, but then it sold off immediately. In this example, we had a bearish crossover on February the 16th. The stock market had already topped more than a week earlier. And so very likely, guys, rallies from this point on will very likely be short-lived and will be sold, right? Even if the NASDAQ rallies all the way up to these prior highs at 321, 322, it will very likely be only an intraday rally and then get sold off. Now, this is the exact opposite of what's happening with the Dow Jones. The Dow Jones has been really strengthening recently, making a higher high today versus the March 31st high versus the April highs. Just been doing exceptionally well. And it did something very critical today. It closed above the resistance line for the first time ever. But it had never closed above this resistance line prior to today. So the question remains, is this another bull trap, right? Is this a fake out, a final fake out before we get the flush down? Or is this the real deal? Now, the answer is a follow through. If we get a follow through day tomorrow, that will confirm a major breakout in industrials, in the Dow Jones, and in old economy stocks. And money will continue to flow out of tech stocks and into old economy stocks, financials, banks, industrials, etc. We know that this is very likely the case because number one, old economy stocks got destroyed after the banking crisis. Number two, we have big banks reporting tomorrow and they will likely show that they gained so many customers and that will be positive. Number three, I do believe that big bank CEOs will try to stay away from scaring investors and talking too much about a recession. And I think that will be viewed overall positively. And most importantly, money is actually flowing out of big cap tech companies, including Apple. Now, we did have a huge update on Apple, but this is not uncommon, right? After Apple breaks its ascending channel, it often does this, right? It retraces back and it completes a double top. It often does this, but more importantly, guys, momentum is now a headwind against rallies. And as long as momentum is declining, as long as momentum is negative, these rallies will be short-lived and they will be sold off. I mean, look at this really face-ripping rally ended up getting sold off. Very likely the same thing is happening again. And if we take a look at Microsoft, it's the same thing, guys. We had a bearish crossover a couple of days ago. The stock is trying to rally again. The PPO is still down and will very likely continue to point down as funds exit these big cap tech companies and goes into more traditional old economy style stocks. Same thing with Google, tagged the upper edge of the ascending channel, has a double top on the PPO and has a negative divergence, a higher high in the daily chart, a lower high on the PPO, and is trying to retrace again. Overall, all of these guys are wedging, they're forming double tops, they're forming bearish structures. And so personally, I am actually avoiding tech stocks to the long side. If anything, I'm interested in shorting these tech companies and going long, again, the industrials. In terms of a resistance level for the overall S&P 500, where does it stop? Well, we have a confluence of resistances at the upper edge of the ascending channel and at this prior high at 417. Now, personally, I still think that the S&P will complete a 3 drives at high, a triple top, 3 highs, each one higher, but with a triple negative divergence on the PPO. That's still my baseline scenario for the S&P. However, I expect the NASDAQ to be weaker here, especially in the next couple of weeks, as again, money continues to flow out of big cap tech companies that led the market from the March bottom, and they will flow into stocks that got really destroyed during the banking crisis. And that's what the market does. It rotates, right? It rotates out of winners into losers, and it does this. It does this in a cycle that is always repeating. Now, specifically for tomorrow, what tends to happen after these really big short squeezes is more and more short squeezes, more and more, right? When we break out of a range, we tend to get these really violent moves. Break out of a range, violent move. Break out of a range, violent move. So I'm not looking to short the S&P and I'm not looking to chase. If I get a good entry, I'll go in. If I don't, I'll just pick stocks, right? There are so many stocks that are setting up beautifully for the long side. A major worry though is all of these gaps. These gaps need to get filled. All of these gaps. This is a major concern. If the market continues to run away from these gaps, that's going to be a major concern, and it has to come back to fill all of these gaps eventually. Now, if the S&P continues to leave these gaps behind and continue to rip, that'll only bring the final top much, much closer. as opposed to the market rallying, pulling back, rallying, pulling back. These pullbacks are healthy. When we don't get these pullbacks, we just get these very violent short squeezes one after the other. I'd be very careful here, especially as the VIX looks nasty. The volatility index looks very nasty. The last time we had the VIX come in at a reading this low was February the 1st. The market ended up topping a day later, right? So you don't want to go long when the VIX is this low. It's just not good risk management. At these extreme lows in the VIX, we usually get short squeezes, violent short squeezes that end abruptly. And so that's a concern now. That would be very unfortunate because it would suck in more and more retail traders and then dumps on them. So hopefully we get something more reasonable, like a gap up in the VIX and then a continuation of the VIX declining, i.e. a gap down in the S&P and then continuation of the rally. That would be more bullish actually. So from a short-term perspective, the close today really switches things immediately from bearish to bullish. This is a significant close. And from a medium-term perspective, the PPO printing a deep green bar today on the histogram means that the medium-term trend is again bullish, meaning that this range breakout will likely continue in the coming days. And the long-term outlook remains exceptionally bearish due to the overall health of the economy, or I should say a lack thereof. And so far, guys, it does look like that the next leg of the rally will be led by the Dow Jones, not the NASDAQ. The NASDAQ is continuing to struggle to make new highs while the Dow is continuing to make new highs and breaking significant resistance levels that lasted for months and months and months. So this is significant as long as we get follow through and it's not just a one and done. And moreover, guys, if you want to actually visualize the rotation out of different sectors like old economy, new economy, one way to do it is to check out the triple Qs divided by the DIA, this ratio, and it takes a look at the ratio of the NASDAQ 100 relative to the Dow Jones Industrials, the Dow 30. And it's very obvious, really, since the beginning of this recent rally after the tech really saved the indices, rally has actually been lagging since then, right? So the Dow has been outperforming the NASDAQ really since March 31st, since the NASDAQ put in its high so far, which was on March 31st. This continues to look like a bearish rollover look in the ratio chart. And areas to look at is the 50-day and the 200-day moving averages, and to fill these gaps left behind all the way at 0.91. That would mean, guys, that the Dow Jones should outperform the NASDAQ by 3 percentage points in the next little while, in the next, let's say, week to 2 weeks. Now I want to talk about a few ratio charts. Up top is high yield bonds, the smart money. Down below is the S&P 500. One worrying sign is that the HYG has actually failed to make a new high today, while the S&P has made a new high. These divergences, guys, usually mark stock market tops, but they're not complete until about 3 or 4 days into the divergence. So what you would be looking for is the HYG to start weakening here and undercutting the previous day's low. If it does that and it starts to create this very deep divergence as the S&P continues to rally, that will mark the stock market top. And so longs at that point would be very wise to take profit. However, if the HYG actually takes out this prior high tomorrow and it continues to make higher lows and higher highs, that would be an exceptionally bullish technical signal in the short term for the S&P and the Dow Jones. If we take a look at another ratio chart, this is copper to gold. Up top is the copper to gold ratio. Copper is used in everything, and when the economy is healthy and growing, you see copper prices rising. When you see the opposite, when you see the economy slowing down, you begin to see gold prices outperforming copper prices, and that's reflected in this ratio, right? This is the ratio between copper prices to gold. And so far, really, since the middle of February, we had copper significantly underperform both the S&P 500 and gold. And this is a very bearish signal for the long term. This is not a medium term signal. It's not a short term signal. This is the weekly chart. And this is a very bearish long term signal. So what does that mean? What does it mean to be bullish short and medium term and bearish long term? Simply means to trade the market, not necessarily to invest, to buy and hold. Not necessarily to buy and hold, but to trade the rallies and sell the dips until eventually the recession rolls around and the S&P says bye-bye and goes down by 50%, as is usually the case. Now let's take a look at futures. This is the 2-hour chart for the S&P 500 futures. And I want to mention this because we're tagging the same highs on the futures market. We were actually unable to take out these prior highs. And so the follow through tomorrow is going to be exceptionally important. We need to see follow through tomorrow to the upside. Otherwise, unfortunately, we go back to the bearish base case because look at this. A lot of wicks here. This is a tombstone doji, a huge tombstone doji. This is a small pullback in the post market. And as long as this remains just a pullback and we move higher tomorrow, that will be very bullish for the S&P, and we will likely continue to rally higher and very likely even take out this prior high in February to finish that 3 drives at a high with a triple negative divergence. Now let's talk about the dollar. The dollar is significantly weakening, and it's been weakening for a while now. And the more we see inflation slow down, the more the dollar is going to weaken. And that's not because of the reaction to inflation. It's actually the market reacting to what the Fed is going to do, right? Because if inflation continues to go down, the Fed is more likely to pause and end the rate hiking cycle. And when it does that, when rates begin to go down, the dollar automatically loses favor against other currencies and it automatically weakens. So far this year, this hasn't been really helpful in catching rallies and sell-offs in the S&P as much as before. And that's because this year, guys, these sell-offs have actually been driven not by inflation, but more so by fears of recession, right? We're now beginning to realize that yes, inflation is declining, but the question is it declining fast enough for the Fed to pivot early enough to save the economy? And the simple answer is no. It's not possible. Even if the Fed actually pivots today, even if they start cutting rates right now, all of the rate hiking that the Fed did throughout the last 12 months, all of that is still trickling through the economy, and it will have ramifications as far out as next year. So even if the Fed actually cuts immediately, all of these rate hikes that the Fed put in starting back in March of last year, they are still going to affect the economy, even if the Fed cuts. And worse yet, guys, is this. This is the DJP, the Bloomberg Commodity Index ETN. And I'm pulling this up because something interesting is happening with commodities. We had PPI come down. We had CPI come down, right? We had commodities overall decline in the last couple of months, significantly so. But recently, commodities have been exploding. And on the weekly chart, commodities have put in the first positive bullish green bar on the histogram and a close above the 20-week moving average. This dark red line will be very, very bad news for the Fed because it will mean a new bull cycle in commodities. And you know what that means? It means a new inflationary cycle. And the cycle of inflation will restart. The Fed will have to raise rates even more, if you can imagine that. And so this is a major worry. I'm actually bullish commodities. I've actually been bullish commodities for a few weeks now. And that's for a variety of reasons. But that's because, well, number one, things like natural gas have gotten hit really hard, and they're due for a pullback. We had the Saudis and OPEC plus cut production of oil. We recently had gasoline prices spike again. Right, gasoline has actually been going up since December. Gasoline prices are going up, and this is again bad for inflation overall because everything relies on diesel and gasoline. Everything in the economy relies on energy costs, especially gasoline and diesel. And as long as the dollar continues to decline, this will actually continue to be positive for commodities because a weaker dollar means a higher price tag on every single commodity because all commodities are traded with dollars. Now let's take a look at the 10-year yield, and there's something very interesting that happened back here earlier this year, and it's this. The 10-year yield has actually now been moving up with the stock market really since this breakdown. After the banking crisis, we had a flight to safety into bonds beginning again, right? Bonds were absolutely poo-pooed last year, and that's because of the rate hiking cycle. And when we get closer and closer to the Fed ending those rate hikes, those bonds become more and more attractive, and they become more and more attractive as a defensive hedge against recession. And so we had that switch, right? We had that switch happen, and then we started to see the stock market move up alongside the 10-year yield. So that's very interesting. And the 10-year yield is now beginning to move back up slightly. And I think the index that most closely follows the 10-year yield is the small caps, the Russell 2000. So if the 10-year yield continues to move up here, guys, I think that will be positive for the Russell 2000. Let's take a look at Tesla. And again, I wanted to talk about Tesla because it's been continuing to disappoint, making lower highs each time, really dragging its feet since that monster run back in January. And again, it has to do with this ratio chart, the XLY divided by the XLP, consumer discretionary divided by consumer staples. This entire move up in the S&P 500 has actually been absent of a rally in consumer discretionary relative to consumer staples. So the consumer remains weak. And we're seeing that reflected in consumer discretionary stocks like Amazon and Tesla. Immediately after the banking crisis, we had big cap tech act as flight to safety, and in the second half of the run-up, we had actually rotation into more defensive, traditionally defensive sectors like XLV. Healthcare has been absolutely ripping to the upside, no signs of stopping. And again, this has been leading the Dow Jones up. If we take a look at consumer staples, again, XLP continuing to rip and outperform the S&P 500. And all of that continues to point to us that this is and remains a counter trend bear market rally. We are still in a bear market because the market is still being led by these defensives, consumer staples, energy, utilities. All of these stocks have been leading the S&P 500, and even energy has been leading the S&P 500 despite all of these fears of recession. Completely reversed, a 180 reversal just over 1 month. So Tesla continues to be relegated to the sidelines. Tesla will very likely only begin to participate in the stock market rally towards the end of the rally, when we get closer and closer to extreme greed, and when we get closer and closer to euphoria and more market irrationality. That's when these stocks like to rally. Things like Tesla, Nvidia, meme stocks, etc. These like to participate towards the end of the rally. Now, another major drag on the NASDAQ 100 is semiconductors. This is the SMH index, the semiconductors index, the chip index, of which Nvidia is the largest holding, divided by the NASDAQ 100. And this ratio has been rolling over for a while now. It looks exceptionally weak. The PPO has crossed below zero. When it usually does this, guys, it will continue to decline all the way to the bottom of this channel. And that's a long way down. That's 12% down relative to the NASDAQ. That's relative to the NASDAQ. So if the NASDAQ declines by 10%, that means SMH, semiconductor chip stocks, will decline by 24%, right? So right now, so far, the market is rotating away from all of these exciting tech names, AI, etc., rotating out of all of them back into defensives, consumer staples, healthcare, utilities, old economy style industrials. And that's the sort of environment where retail traders tend to suffer, because retail traders, we like to trade tech companies. We like Apple, we like Microsoft, we like our Nvidia, we like these kinds of stocks. But as long as you understand sector rotation, you can make money in any market condition. And so I hope that you find that helpful in today's video. Now let's talk about market breadth. And we got the first warning sign today. Remember yesterday I said that market breadth looked pretty healthy, surprisingly, right? It did not take out the prior low. Well, today market breadth has actually failed to take out the prior high. So we got high yield bonds, the smart money, warning us that the market is now entering into uncharted short squeeze, crazy style trading. The kind of behavior that usually comes, guys, towards the end of any rally, right? This kind of crazy short squeeze behavior that comes at the end of rallies, And this is one of those warning signs that, yes, breadth is not keeping up with the stock market. If I take a look at S&P 500 200-day breadth, again, below yesterday's high. If I take a look at the broader 200-day breadth of the overall stock market, not just the S&P, again, guys, below yesterday's high. And that continues to be a concern. And so by all means, if you want to trade the short squeeze, go ahead. Just be aware of the risks involved and that it can switch on a dime. The NASDAQ summation index is trying to maintain its positive upward trajectory. It is really suffering, again, because of the chip stock, suffering because of big cap tech companies all basically hitting major resistance levels. And so, again, I continue to be bearish on the NASDAQ, on tech in the short term. And I would lean more heavily into defensive style names and old economy stocks. Put to call ratio, the gold standard money time machine put to call ratio. Usually, guys, when the put to call ratio dips all the way below the 0.8 reading, that's when we get stock market tops. And sometimes the market tops before that happens, as long as we get a bullish crossover on the PPO. So far, none of those have happened yet. And that's why I still believe, guys, that we get a 3 dries at a high. And that's also why I did not call yesterday's local top, the double top, as the final top, simply because the put to call ratio is still not there and the summation index hasn't crossed down yet. And so that would indicate that we could still see upside from here. Just be careful trading this last bit of the rally. Now, in terms of economic events, tomorrow we'll have retail sales and the consumer sentiment index. Retail sales will be before the market open, and consumer sentiment will be 30 minutes after the market open. And in terms of earnings, we'll have JPM, Citi, Wells Fargo, and BlackRock reporting tomorrow. In terms of fear and greed, guys, we are still trying to rally towards that extreme greed reading of 75. We're not there yet. Usually, guys, the market does top around that reading. We're not quite there yet. Market momentum really ripping to the upside today. Stock price strength improving, but still below the February high and even the December high. Breadth still, guys, below even the December highs. So again, breadth is not favorable so far. Put call ratio, I talked about this yesterday. I think it continues to go down. Market volatility was trying to find a bottom. Yesterday it was forming this cupping formation, but it failed today. It broke below, and it gave us one of the lowest readings in a very, very long time. You'd have to go all the way back to February to find a reading this low, and then even further back to January of last year, when the market actually topped last year. That's the last time we had a VIX reading this low. So be extremely careful when the VIX is this low. It just means that the market is very complacent and very susceptible to major rug pulls and really bad, nasty things. Safe haven demand actually still holding up versus the S&P 500. Junk bond demand actually slightly improving. Again, showcasing that in the short term, risk appetite is back in the market. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.